Hi guys, I'm Dan, this is Kai, we're the directors at Crescent Mortgages, and today we are bringing you another FAMQ, frequently asked mortgage question. It's not actually a mortgage question today, is it? It's an insurance question. So we're going to be talking you through income protection. Before we do, just to remind you that we are mortgage and protection experts with a combined 20 years experience in the industry. We're both CMAT qualified. Anything else to add there?
No.
You happy with that?
Yeah,
I'll
take
take
that.
Let's jump into it then. Okay, so if you are tuning into this video, then there's a good chance that you have some level of interest in income protection. You either have it already, you're potentially looking to take some out, you just want to understand basically what it is. It's not always the clearest. So we just want to talk you through the basics of what it is and how it works. And then obviously if you do have more questions, you can get in contact with us. So first of all, what is income protection? I'll go. So do you want to go?
No, you can go. It's fine.
I'll go.
Yeah.
Do you not know?
Mate, inform us. No.
So income protection is a type of insurance that will pay you a regular monthly income if you are signed off of work. So the idea is that it will replace your income if you're unable to work for a specified period or after a specified period, a pre-agreed deferred period. It will continue to pay you every month until you either return to work, the doctor says you're ready to go back to work, or until the policy ends. So if you've agreed that you're taking out the cover for 30 years and you claim at the end of the 30 years, the cover will then stop, or when you pass away. So if you pass away, then of course it will stop paying you an income. In terms of how it works, so anything to jump in there?
Yeah. Dan touched on one of the points there briefly. So it will pay you once you have been off work for a pre-agreed period of time. So you'll set what's called a deferred period. That might be a few weeks, that might be months, that might even be a year, depending on how long you think you can get by without the insurance. But effectively it will pay after a pre-agreed period of time, and it will pay if you can't do your job for any reason. In short, that's the gist of it. If you're off work, your doctor signs you off, or whatever it may be, then the insurance should kick in.
Yeah, I guess just to elaborate on the deferred period. So the two things that a few things that will kind of determine what deferred period you agree. So the first thing is, as you can imagine, the shorter the deferred periods, the more expensive your insurance premium is going to be. So if you have a policy that's going to start paying you immediately, so the day you are signed off of work, you start to receive an income, or a policy that has, let's say, a 4-week deferred period, so after you being off work for a month, it's going to start to pay you an income, that's going to be a more expensive insurance policy than if you have a policy with, let's say, a 6-month or a 12-month deferred period, because of course the payments aren't going to kick in as quickly. It might be that you're off work for 2.5 months, you return to work, and if you had a 3-month or a 6-month deferred period, you'd never actually receive a penny because you'd have gone back to work before the actual money from the income protection policy kicks in. The other point just to highlight is that if you're employed, your income protection policy won't kick in until your work benefits have stopped. So if you've got, let's say, sick pay through your employer that will pay you for 6 months, if you're signed off work, then you would want to tie in your income protection policy so that the deferred period is 6 months. So you'd have 6 months receiving your sick pay if you were unable to work from your employer, and then when that sick pay ceases, then the income protection policy would kick in. You can't have an overlap where you're receiving sick pay and money from the income protection policy.
Yeah, I suppose then the other point on how it works and the reason probably why you can't have your work benefits and the income protection together is income protection will pay you a portion of your income. It won't give you your full salary or your full income back. It will give you a tax-free income up to a certain figure. Insurers, it differs slightly with how much they'll give you. It might be 50%, 60% maybe.
As a maximum.
As a maximum of what they can offer you. They can't pay you more than what you're earning, for example, or anything along those lines. So it is based on your income as the policy says.
Yeah, but you can take out, so you don't have to go up to that limit. So even you could take out an income protection policy that, let's say you're currently earning £4,000 a month after tax, you could take an income protection policy that only pays you £1,000 a month. Of course, it's not going to fully replace your income, but it is still going to help you financially if you can't work. And I guess one of the reasons why someone would potentially take a smaller amount of cover, as with the deferred period, is because that will impact the premium. The higher level of cover that you have, the more expensive the insurance is going to be. So again, you want to potentially balance how much cover you need with how much you're willing to pay, and obviously your mortgage broker can kind of talk you through that and work out what's going to be best for you. In terms of kind of who would take out the cover and why would they take the cover?
Yeah, it seems to be most popular with self-employed people generally, because if you're off work, no one's going to pay you. If you're running your own business, you generally aren't going to get the sick benefits or sick pay that you get through an employed role, or even people that are employed but maybe have limited or no work benefits or no sick pay. But generally, it's those two people, I would say, that are the main people that are interested in replacing that income, because they know how policy can be going.
But as Kai says, I mean, they're the people that often we get calls from self-employed people or people that don't have any work benefits. But actually, for a lot of people, for a lot of employed people, this cover is applicable because your company's sick pay normally won't last forever. So let's say it's only paid for 6 months or 12 months. Once the sick pay ceases, you're going to be on the bare minimum, which likely isn't going to be enough to maintain your bills and your mortgage and that kind of thing. So even if you are employed, if you don't think that you could support your mortgage if you were off work for, let's say, a year or longer after your sick pay ceases, then really, this might be a cover that you should look at as well. Just a final couple of, again, without delving kind of too much in, just a final couple of points that we wanted to cover. Anything that you wanted to tell them?
Yeah, okay. So I think often cover is what they call index linked, or you might hear it's inflation proof, or whatever you want. Basically, it will go up. The premium and the benefit will go up in line, often in line or around inflation. What it's trying to do is, if you were to claim today and you were to claim in 20 years' time, cost of living is always going to be higher in the future, as it does. So the policy will try to make sure that if you're getting £1,000 a month, you're getting the equivalent of what is £1,000 a month in the future. So the benefit will go up, as will the premium to match it generally.
Yeah, so you don't
have choice.
You don't have to index link your cover, but for something like an income protection that potentially replaces an income, is often sensible, because if you're receiving £1,000 a month on your policy, that's not going to get you as far in 15 years where you might make a claim than it is today. So index linking the policy just means that the premium and the sum assured that it would pay you each month both go up roughly in line with inflation. Just a couple of other types of cover. You can look at short-term income protection that doesn't pay you for the full term. It just pays you for a year or 2 years. That is cheaper often, but again, it's not as comprehensive because it would stop paying you after a pre-agreed period. And you can also get age-costed premiums, which basically mean that they are going to increase the premium over the years as you get older. So you're not necessarily going to be getting, you are potentially going to be paying more in the future. Oh. Who's that?
Hello.
Where were we? So age costed cover basically means that they're going to increase the premium potentially every year as you get older. It's not ideal necessarily, but it can sometimes work out cheaper. So again, you can kind of ideally play around with that with your broker to work out what's going to be best for you. I think the final thing we just wanted to highlight is that when you apply for the cover, you will have to complete a health questionnaire, as you do with any life insurance. If you have any kind of pre-existing medical conditions or injuries, there is a reasonable chance that they will impact your cover. So if you've got previous problems with a shoulder and you're in a manual job and that impacts your ability to work, then there's a chance that they could exclude that illness or injury from the policy, which obviously isn't ideal, but again, it does depend on the insurer and it depends on the severity. Or they can sometimes cover that, but they may increase the premium to reflect the fact that you're higher risk. So again, that obviously differs massively from person to person, depending on what illnesses and ailments you carry, but it's just something to bear in mind. But again, if you speak to your mortgage broker, if you give us a call, mortgage or protection broker, then we'll do the research and speak to the right insurers to work out who's going to give you the best possible terms based on your circumstances. Anything else for you to add?
I think I probably just reinforce one of the points we made right at the start is that it can pay for literally anything though. So that's the difference between this and a lot of the other insurances that you might be looking at. If you are looking at insurances in general, is income protection can pay you for being signed off with mental health, a bad back, a broken leg. It can pay you for those sorts of things, not just cancer or a heart attack or something that maybe is more severe.
Yeah, that's a good point.
Which is quite a big differential between them.
Unlike critical illness, when it pays you, you have to meet the definition of that illness to receive the payout. Income protection is as simple as if you are signed off of work by your doctor for anything, then you will be eligible to receive the payout after the deferred period. Like Kai said, if it's mental health, if it's an injury, if it's an illness, bad back, anything that puts you off of work, you will be eligible for payment 99% of the time. I'm happy with that. Yeah. Guys, if any questions, or if you do want to kind of review your life insurance or have any questions, want to get a quote, give us a call, drop us a message, or leave it in the comments, and we will see you next time. Thanks.